How is the housing market affected by what happened with Silicon Valley Bank and other bank failures in the US economy? As you all know, the Fed is trying to tame inflation, trying to bring down the costs and prices of different things around the economy, such as home prices. And in order to bring down home prices, the Fed has to increase interest rates. But as we have just seen over the past few days, that's not the best thing for a lot of banks that hold a lot of bonds, because it makes their older bonds not as attractive as newer bonds with higher interest rates. So today's video, I'm going to share my screen with you all, share some charts, and let's just go over what effects are done on the housing market because of what happened with these different bank failures. Before we go on, please be sure to subscribe to this channel for some more content around the housing market, personal finance, and the economy as a whole. All right, so right here, I'm looking at the US 10-year Treasury yields. And as you all see, in the beginning of March, it closed at over 4%. And then after what happened with Silicon Valley Bank, Signature Bank, and Silvergate Capital, it fell to its lowest point at 3.51%. And this is just talking about these last couple of weeks, not talking about beginning of the year or anything like that. And so you see that the interest rates on these yields, or the yields itself, just went low. And so that has a direct correlation to mortgage rates. And so the higher these rates are, the higher mortgage rates are. And so you see this dip down with these interest rates. In turn, mortgage rates dropped. Reading this article right here, the 30-year mortgage rate dropped to 6.5% on Monday. And that's down from 6.76% on Friday when SVB failed, and 7% on Thursday. So it went from 7% on Thursday to 6.7% on Friday to 6.5% on Monday. And so that's almost a 0.5% lower with mortgage rates in the housing market. And so with lower rates, any sense or any hint that mortgage rates are dropping, that brings demand to the housing market. And the more demand that you have in the housing market, home prices usually go up. I'm just going to read over this article and just highlight a few different things. In this article, they were saying that they do expect mortgage rates to drop because the Fed, in order to tame inflation, they raise interest rates. But now what happened with these banks, they may not be as aggressive with raising interest rates because they don't want more banks to follow what just happened with these banks that just failed. And so before, it was predicted that Jerome Powell, the Fed, was going to raise interest rate another 50 basis points. But now with these bank failures, they are estimating a more conservative 25 basis points. And so that does lower the expectation that banks have to increase their mortgage rates. So mortgage rates may dip even lower. Something similar happened earlier this year. Almost dipping below 6% at the beginning of February, mortgage applications for purchases and refinances perked up. So when you start to see lower interest rates, because I believe it reached over 7% in October, and then in December and January, it went below 6%. So that attracted new people to the housing market, which increased home prices. And so the thing is, yes, it's great that mortgage rates are going lower because in a way makes it more affordable. But the thing is, interest rates are not going to go lower than what they were last year around this time. And home prices are still elevated, and that would raise home prices even more. And so in reality, a person actually wants mortgage rates to go up. They want the Fed to continue on their path of increasing interest rates in order to lower home prices so it can be more affordable for most people. Now, some people are arguing that this is a very short-term thing and it may not stay low as some people are predicting. Right here, they're saying that it did attract some folks earlier this year, but it took weeks of lower rates to attract consumers and create even a modest increase in activity. So here they're just saying that earlier this year, yes, there were lower mortgage rates, but the increase in home prices, the increase in mortgage applications didn't happen until weeks after rates were lower than 6%. And so if this is just a temporary dip where the Fed can quickly handle whatever's happening in the banking system, some people believe mortgage rates will go back to a higher level, even over 7%. If it stays short term, then there shouldn't be any different housing activity activity. This shouldn't increase demand. This shouldn't increase home prices and purchase activity, which is something that as a consumer, we want, right? We want there to be less demand, more of a supply, so home prices can go down to more attractive prices for us. Keep on saying that throughout the whole video. And here they state that what is unclear though, is this a temporary dip? Is this going to be the Fed pivoting earlier than they planned? And if they do pivot earlier, will that mean that there's inflation later on? They have to deal with that, maybe worse than if they had stayed the course. So here, this person is essentially saying that if the Fed actually takes this issue extremely seriously, more than what they need to, and they actually tame the rate at which they raise interest rate or even stop raising interest rate for the next couple of Fed meetings, yes, that can help the banks at its current situation, but that will not help inflation that is still running rampant in the US economy. And so yes, you can fix this issue, let prices stabilize, but you may have to reap the consequences later this year if home prices start to rise and inflation goes back up. So the best route, in my opinion, is to continue on the path of raising interest rate. Because of what happened with the banking system, maybe they'll just increase it by 25 basis points, but I still believe they need to be a little bit more aggressive with raising interest rates so we can drop home prices day by day, month by month. Now, looking at the consumer price index that came out on the 14th of March, we see that February, the CPI increased 0.4% in February, right? After increasing 0.5% in January. We see that difference right here in this chart. And this is great. Like, it didn't increase to like what it did last year, right? February 2022, it was 0.7%. Now, I do believe this should be lower, but this is what we're working with. And you can see like these months right here when interest rates were increasing at an extremely high rate, these rates are well below 1%. Most of them are 0.5% or lower. Where right here, when the Fed weren't doing that as much, you see most of these bars are definitely higher than these months. So if we can continue with these just small increases in CPI, because things are going to increase no matter what, and hopefully we can have some months like July where it doesn't increase, or even a few negative months, right? So we can bring prices of different commodities down to make it more affordable for most people. All right, you all, let me know your thoughts on the effects of Silicon Valley Bank and what happened in the market and its effect on housing, on home prices. At the end of the day, because the Fed is trying to fix their problem with the banks, that in turn will lower mortgage rates, but we don't know if this is just going to be temporary or more long-term, so banks don't completely fail and the Fed just starts to concentrate specifically on banks, because if they do that, then they're not going to address the inflation issue in home prices in the housing market. It's a very difficult job the Fed has, and all props to Jay Powell in handling this issue of making sure banks don't fail, but at the same time, inflation goes down and home prices go down. The thing is, when you raise interest rate, inflation usually goes down, but with that, you have more banking situations like what happened with Silicon Valley Bank. And by the way, I did make a video on what happened with Silicon Valley Bank. Please be sure to check out that video. All right, thank you. Peace.